So good evening, everyone. We are going to discuss about PFR's 10 consolidated financial statements. So I am Lady Dimple Simenyoza, and I will be the first reporter. Next, please. So PFR's 10 prescribes the principles for the preparation and presentation of consolidated financial statements. So we have the terms here, group, parent, and subsidiary. And I think all of us here know these terms already. So group refers to the parent and its subsidiaries. Parent refers to an entity that controls one or more entities. And subsidiary is the entity that is controlled by the parent. So parent and its subsidiaries prepares its own financial statements, but PFRS 10 requires that the financial statements of a group, which the assets, liabilities, equity, income, expenses, and cash flows of the parent and its subsidiaries are presented as those of a single economic entity. So the separate FS of the parent plus the separate FS of the subsidiary goes through consolidation procedures, creates consolidated financial statements. So business combination at the date of acquisition is accounted using PFRS 3, while the preparation of consolidated financial statements after the business combination is dealt under PFRS 10. Next slide, please. So all parent entities are required to prepare consolidated financial statements, except as follows. So these conditions should be met in order for the parent to be excused in preparing consolidated financial statements. So first is, a parent is exempt from presenting consolidated financial statements if A, it is a subsidiary of another entity and all its owners do not object to its non-presentation of consolidated financial statements. B, its debt or equity instruments are not traded in public market. And C, its ultimate or any intermediate parent produces consolidated financial statements that are available for public use and comply with PFRSS. So I'll have an example here, like let's use the triangle. So this triangle is composed of three layers. So the topmost, in the middle, and the bottom. So this topmost level refers to the topmost parent, and this topmost parent has a subsidiary, katong naa sa middle, and this middle is a parent as well of its own subsidiaries. So the bottommost part of the triangle is its subsidiaries. And this parent, ang nasa middle, will be exempt from presenting consolidated financial statements if it complies with the aforementioned conditions, this A, B, and C. And next is number 2, post-employment benefit plans or other long-term employee benefit plans to which PAS 19 applies. Next slide, please. So, control of an investee. An investor controls an investee when the investor is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. So, only one entity is identified to have control over an investee. So, if 2 or more investors collectively control or must act together to direct investees' relevant activities, then none of them individually controls the investee. So, each investor accounts their interest in the investee in accordance with PFRS 11 joint arrangements, PAS 28 investments in associates and joint ventures, or PFRS 9 financial instruments. Next slide, please. So control exists if the investor has all of the following. First is power over the investee. Second, exposure or rights to variable returns from the investee. And C, ability to affect returns through the use of power. Next slide, please. So power is defined as an investor has power over an investee when the investor has existing rights that give it the current ability to direct the investee's relevant activities. So what are these relevant activities? Relevant activities are the activities of the investee that significantly affect the investee's return. So the investor's ability to direct investees' relevant activities is often evidenced when the investor has the ability to establish and direct the investee's operating and financial policies. Next, please. Next slide, please. So examples of rights that either individually or in combination can give an investor power include A. Rights in the form of voting rights of an investee. B. Rights to appoint, reassign, or remove members of an investee's key management personnel who have the ability to direct the relevant activities. C. Rights to appoint or remove another entity that directs the relevant activities. D. Rights to direct the investee to enter into or veto any changes to the transactions for the benefit of the investor. And E. Other rights that give the holder the ability to direct the relevant activities. Next, please. So, administrative rights. So, these administrative rights happens when voting rights cannot have a significant effect on an investee's return. So the investor needs to assess those contractual arrangements. So the next topics will be discussed by my other classmate.
So in continuation with what was Ms. Minosa have reported, in my report, I will report about unilateral rights, protective rights, substantive voting rights, and potential voting rights. So for unilateral rights, if when two or more unrelated investors each have unilateral decision-making rights over different activities of an investee that significantly affect the investee's returns. So the investor that has the current ability to direct activities of the investee that most significantly affect the investee's return is the parent controlling the investee. So in effect, the power is attributed to the party that looks most like the party that controls the investee. So next, we have the next slide, please. We have protective rights. So protective rights are rights designed to protect the interests of the party holding those rights without giving the party power over the entity to which those rights relate. So in evaluating whether rights give an entity power over another entity, the entity shall assess whether its rights and the rights held by the others are protective rights. So protective rights relate to fundamental changes to the activities of another entity or apply in exceptional circumstances. So an investor can have power over an investee even if other entities have existing rights that give them the current ability to participate in the direction of the relevant activities. For example, when another entity has significant influence, however, not all rights that apply in exceptional circumstances or are contingent on events are protective, and an investor holds only protective rights does not have power over an investee and consequently does not control the investee. So we have three examples of protective rights. First, we have a lender's right to restrict a borrower from undertaking activities that could significantly change the credit risk of the borrower to the detriment of the lender. Next, the right of the party holding a non-controlling interest in an investee to approve capital expenditure greater than that required in the ordinary course of the business, or to approve the issue of equity or debt instruments. Lastly, the right of a lender to seize the assets of a borrower if the borrower fails to meet specified loan repayment conditions. Next slide, please. Next slide, Joby, please. We have substantive rights. So the rights whether the holder has the ability to exercise. So an entity is in assessing whether it has power, considers only substantive rights relating to another entity or held by the other entity and the others. For a right to be substantive, the holder must have the practical ability to exercise that right. So determining whether rights are substantive requires judgment, taking into account all facts and circumstances. The factors to consider in making that determination include but are not limited to whether there are any barriers, it's either economic or otherwise, that prevent the holder from exercising the right. For example, of such barriers are but are not limited to financial penalties and incentives that would prevent the holder for exercising its rights, an exercise or conversion price that creates a financial barrier that would prevent the holder from exercising its rights, and the term and conditions that make it unlikely that the right would be exercised. For example, conditions that narrowly limit the timing of their exercise. So to be substantive, rights also need to be exercisable when decision about the direction of the relevant activities needed to be made. Usually, the the rights need to be currently exercisable. However, sometimes rights can be substantive even though the rights are not currently exercisable. So, substantive rights exercisable by the other parties can prevent an entity from controlling the entity being assessed for control, to which those rights relate. So, such substantive rights do not require the holders to have the ability to initiate decisions. As long as the rights are not merely protective, substantive rights held by the other parties may prevent the entity from controlling the entity being assessed for control, even if the rights gives the holder only the current ability to approve or to block decisions that relate to the relevant activities. Next slide, please.